You had Larry Fink of BlackRock on our network hour or so ago. Inflation higher for longer. Long rates will be above 5%. That does not sound like Goldilocks to me.
What a difference a week makes, don't you think?
I don't know, maybe a day. I was calling you Jimmy Goldilocks yesterday, but I'm not calling you that today.
There were some cracks yesterday. We acknowledged them with that CPI report. Really needed that CPI report, folks, yesterday to come in softer than expected. It didn't. So here's what we're looking at. Inflation is indeed a little stickier than expected. I don't think that's fatal for the markets. I think we're talking about inflation with a 3 handle now. I'm going to say something that may not be popular. It may even get my committee mad at me. But as we go into 2024, you know, we got to figure out that this is an election year coming up in 2024. And if you've got headline CPI at 3%, yes, Jay Powell and everybody else says 2%. I think they're going to be hard-pressed, folks, to put this economy into a recession, which, frankly, is what's necessary to get down to 2%. I don't think they're going to do it in an election year. I think they're going to settle at 3%. And that's going to keep rates where they are right now. I understand before anyone jumps on me, that's not the prevailing sentiment. I am very comfortable being outside the mainstream.
Weiss.
I can't find anything more unattractive than jumping on him. Listen, it doesn't matter if rates stay if they raise or not. It's that rates stay where they are. Even if rates come down a little bit, it doesn't matter. The economy is going to recession. We keep seeing the data trending that way. So the bull case built upon Sands essentially saying, no more hikes, just doesn't matter. The die is cast. You're seeing a delayed reaction to the massive tightening cycle that we've seen. So as you look at investing in the market and in stocks, you always have to decide what's the risk and what's the reward. There is no near-term reward. Jimmy, hold on. As you would say, hold on, cowboy, or cowgirl, whatever your nomenclature is.
Dude, just freaking go, man. God.
I'm going. Tell him to stop and try.
Well, stop with the stupid comments and jokes. Just make your point. Come on, man. Seriously.
Okay, if you look at the risks and the rewards, where are the rewards? The reward is based on hiking rates, right? That's not going, maybe that doesn't happen, doesn't matter. The die is cast, as I said. Look at the risks. The risks are that we see an escalation of the issues that we're seeing in the Middle East. What happens then? Possibly oil goes to 150. Right? If oil goes to 150, you're not going to be able to avoid a recession. We don't know what's going to happen. Low probability Iran gets involved, but the possibility is there. The risk is still there. So let's take a look at the balance there. There is no balance. It firmly tilts to the risk side of the equation. Then, coupled with, yes, the equal weighted S&P, maybe valuations aren't that high, but as earnings come down, what we're going to see this quarter is a moment in time with earnings moving higher. We're seeing some earnings come out. They're not good. Even if you look at the earnings that reported today, the banks, what they're talking about is a slowing consumer. What leads the economy? 60%, 70% leads the economy. So to me, it's a very obvious case. I understand being bullish. I'm not advocating selling everything. I think that you don't sell stocks where you have good gains in, but I also think it's the point in time where you assess your portfolio and you say, what am I married to? What will stand the test of time? What can I get into substantially cheaper on a reversal in the market?
200,000 weekly initial jobless claims. The labor market is strong. Inflation is 3.7%, not 9%. Disposable income is going up. You listened to Ed Bastian at Delta yesterday, where earnings beat, and he sees demand strong. You listen to Jamie Dimon today. He says the consumer and corporate balance sheets are healthy. I will grant you there are risks. You're not an idiot. You're not completely wrong. What I'm saying to you is there are a lot of positives out there. As much as you accuse me of ignoring the negatives, I accuse you right back of ignoring the positives. And while I think the positives outweigh the negatives, even in a tie, human nature is to grow and expand and build.
You see, I'm not ignoring the positives. I'm absorbing the positives into my bearish case, which pushes rates higher for longer, maybe even higher than where they are now. Because it wasn't good news. The jobs number wasn't good news.
Yes,
as you said in your preamble, CPI was not good news.
It was bad news either.
Okay, so I look at that. So look, reasonable people can disagree. You're reasonable, I'm reasonable. We're both doing this a long time. I'm just looking at the future and the trends where I believe, with all due respect, you're focused on today and single data points, not the trends.
So, Joe, you want to step in and settle it on either side? I mean, I bring up again what Larry Fink said. You know, if he's correct that the essential point he's making is inflation is going to be sticky, and the long rates are going to remain higher than I think people are ready for. 5% is not exactly a Goldilocks environment.